The residential solar industry has been absolutely decimated over the past year or so. One company that's held up relatively well is Enphase Energy. They reported earnings last week. Results were pretty good. Seems like we're hitting some sort of bottom in the market. That's what a lot of observers in the industry, a lot of executives have been talking about, is that the second half of 2024 is going to be better than the first. We work through a lot of inventory challenges. But this quarter also showed some of the strength of Enphase's business model, their asset-light business model. This is a company that, as bad as things have gotten in, revenue is down over 50% from a year ago. They still generated positive free cash flow. So that's just a phenomenal position for them to be in. Is the stock a buy? I'm going to try to answer that question based on recent results, based on the company's valuation, and where the market might be going from here. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So first, let's get to what happened on the market last week. You can see that the reaction to earnings was really positive. Shares were up about 10% last week. Still down about 23% over the past year, but this is much better than a lot of their solar competitors. Still about a $16 billion market cap. So still a really valuable company compared to a lot of the companies that it's actually selling its products to. All right, so let's get to the actual numbers, because some of these are pretty jarring if you have not looked at Enphase recently. You can see that quarterly revenue, $303.5 million. That was down over 50% from $711.1 million a year ago. Operating expenses also coming down. But look at this. They're still generating a net income for the quarter, $10.8 million, so relatively modest. But that's down from $157 million a year ago. On a non-GAAP basis, $58.8 million in net income for the quarter, for 43 cents per share. And like I said, that free cash flow, $117 million, ended the quarter with $1.65 billion worth of cash. So despite everything that's gone on in the industry, still doing really well from a cash perspective and also free cash flow. We are also seeing signs that there is going to be a rebound in the business in the second half of the year. Remember, $303 million in revenue for the second quarter. Revenue expected to be $370 to $410 million for the third quarter of 2024. Gross margin still expected to be pretty high at 45 to 48%, including the IRA benefit. The Inflation Reduction Act continues to be a massive boost to companies like Enphase, First Solar. Without that, you can see the difference between non-GAAP gross margin, 47 to 50%. With the IRA, you pull out the IRA, you get to 39 to 42%. So about an 8% boost to margins just for the Inflation Reduction Act. So what is going well for Enphase? Because I think it's worth discussing why revenue is expected to go up in the third quarter. And one of the big things is Enphase's main business has always been selling these microinverters. So it's a little tiny inverter that sits on the back of a solar panel. It's called a module level power electronics. This way you can shut down a single solar panel instead of shutting down the entire system if there's a problem. But the big change, particularly in California, was related to net metering 3.0. Net metering is basically what the grid will pay you for electricity if you're sending electricity to the grid. And there's a bunch of changes that have happened over the past decade. The most recent took effect a little over a year ago, or started to take effect a little over a year ago. And that made it less cost effective for customers in California to send electricity to the grid. Actually gave them an incentive to self-consume that electricity. So what that means is that a company like Enphase is going to sell more batteries, this IQ battery that they have right down here. So solar panel produces electricity. You use some of that at the time that that's produced. But previously, any excess that was produced during the day in particular was going to be sent back to the grid. So this utility meter would basically spin backwards. And then when the sun went down, you would just consume electricity from the grid. Now what's going to happen is more customers, and now a vast majority of customers in California are actually getting batteries with their solar system. So the installer then has to figure out, what kind of battery am I going to put? Well, while I'm buying Enphase microinverters, I might as well just include a Enphase battery. That way Enphase can be the brains of the entire system, and that increases the revenue per installation for Enphase. That's really the benefit for Enphase. So the number of systems being installed are actually coming down, but the revenue overall for Enphase is going up because they are generating more revenue from each one of those installations. That's kind of the dynamic that's going on, at least currently in California. Not quite the same in the rest of the US and actually the rest of the world, but we're probably headed in that direction in many places. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So the great news for Enphase is that installations are starting to improve. The excess inventory that was in the system is starting to work its way through. That's why you're going to see revenue increase in the third quarter compared to the second quarter of 2024. You're also starting to see more revenue per installation. That is going to be a tailwind for the company long term. Now, those batteries are not going to have quite the same margin profile as inverters did, but it's still going to be a great business for them to be in because it's something that they can basically bundle together when selling products to their installation partners. Now, the question with all of that is there enough of a recovery for this to be a buy from a stock perspective? And this is where I run into valuation challenges with a company like Enphase. I'm going to just give some of the numbers here. The enterprise value to sales multiple currently is 11.2. But let's say that Enphase gets back to a $700 million run rate per quarter. So they're doing $2.8 billion in annual revenue. The enterprise value to sales multiple would still be nearly 6. So that's just an extremely high multiple for a company that at the end of the day is a hardware company. They're also relying on a lot of subsidies that may not last forever, depending on what happens politically. And from a competition perspective, those margins that Enphase is getting from the Inflation Reduction Act may start to compress. I think this is something that we've seen over and over again in the solar industry. Subsidies don't typically drive long-term increases in margins because those margins are going to get competed away. Somebody else is going to start manufacturing their inverters here. They're going to try to undercut Enphase's prices. Now, that may not be quite that simple, but that's the dynamic that typically happens in the solar industry. So these high margins get competed away over time. So this is one of these situations where I think Enphase is a phenomenal company. It is incredibly impressive that revenue can drop in excess of 50% and they can remain profitable and free cash flow positive. That just shows you how good of a job they've done controlling their cost structure, controlling their operating expenses. But that doesn't mean that you should pay any price for a stock like this. And I think at the end of the day, even a recovery to that $700 million range in quarterly revenue still makes this a very, very expensive stock. You're still expecting margins to be near 50%, which just, again, typically don't last in a manufacturing industry. Now, there may be reasons that Enphase is able to do that because they are the brains of the solar system. They're really what ties everything together. They're going to be likely the high margin point in every solar installation. But the irony of that, the irony of the high margins that they have is the more money that Enphase makes, because it's the most expensive component in each solar installation, the more money they make, the more expensive it is for solar installations, the harder it is to sell more solar installations because of the high upfront cost. So that's why this is just too high a price for me to pay for a company like Enphase. I think it's a very, very well-run company, love their position in the market, but I'm not a buyer today because I just don't see the stock being a good value currently. But what do you think about Enphase? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.